Hi, everybody. Welcome to today's Solution Spotlight. I am going to give it about a minute or so before we turn things over, or before we get things started, I rather should say. And yeah, we're very happy that you're able to make it today. So, Megan, 2 weeks left until summertime. What do you have planned until then? Any fun stuff?
Nothing too crazy, just a few more webinars, and we will be going to Michigan this summer, so that's our favorite place to vacation. So my son is counting down the days until we get to be in Michigan on the beach.
Ooh, that's nice. Do you have family there or just like to go there?
We just like to go there. St. Louis is pretty humid, and Michigan is very nice in the summer, especially late summer. And so my mom's actually been going since she was a kid, and just have never really changed. We're, I would say, one of tradition.
Yeah, just continuing that fun ritual. Oh, that's sweet. We back when I lived in California, we would go to Lake Tahoe every summer and that was just beautiful, nice getaway from Southern California heat. And yeah, just great to be on a beach and not like a crowded Southern California beach, but I guess Lake Tahoe is also crowded, but in a different way.
Yeah.
Anywho, well, to everybody else, hope that you all have fun summer plans. And for now, we're going to have a really fun solution spotlight for you to listen to. So, welcome to today's solution spotlight, property and casualty insurance, what financial advisors should actually look for with Holistiplan. My name is Sarah Williams. I am XYPN's Senior Partnerships Operations Manager, and joining me today is Megan Dowd, Director of Insurance at Holistiplan. In this session, we'll break down the property and casualty insurance questions advisors often have, but rarely get to ask, from rebuild costs and umbrella coverage to common policy gaps and overlooked exposures. And you'll walk away with practical ways to approach these conversations without needing to become an insurance expert yourself. Now, there's a lot to cover, so I will go through these housekeeping items as quickly as I can. So, first, there's going to be some time at the very end for any questions, and then if we don't get through all of the questions, then we'll send a follow-up with those just later on post webinar. But for now, just as questions come up, drop them in the Q&A tab and you can upvote questions as appropriate. But yeah, just drop them and all questions are welcome, no matter how what judgment you might put them on them. And then next, we have some upcoming events from XYPN's side. So first, there's too much data, not enough clarity. How to simplify client conversations with elements. That's happening on Tuesday, May 26th. So in less than 2 weeks from now. And then marketing your firm. Here's how to stay on the right side of the SEC. That's happening Wednesday, May 27th. So yeah, still less than 2 weeks from now. Last but not least, my favorite event of the year, XYPN Live, is heading to San Diego, another my favorite place on the planet. So that's happening end of September, and I encourage you to grab your pass. All three of those events that I just shared, I will also share the registration links. So if you're curious, if you want to learn more, click on those links and learn more, register at your as you will. And that is it from me, Megan. I will turn it over to you.
Thank you so much, Sarah. And thank you all for being here today. Super excited to go through this with you. And as Sarah mentioned, please feel free to put in any questions. I don't believe in a dumb question. We do cover some complicated things here, so feel free to post anonymously if you are worried. So one thing I really just want to start with is you all have so much context about your clients that insurance agents would love to have. And so really what we want to talk through today is how do you translate everything you know into a better insurance experience for your client. And really, the missing piece that I've learned in working with advisors over the last 10 years is it's just the vocabulary that you all are missing. And so today, we're really going to focus on that vocabulary, what it means, and kind of the impact it can have to your clients and your book of business. So, one of the biggest problems is a lot of times we don't find out that our clients have outgrown their insurance or there's a gap in coverage until the claim's uninsured or completely underinsured. And then they're coming to you as the advisor asking for solutions, maybe an attorney's name, maybe, some money from assets under management. But that's really not the right time to find that our clients have a gap. The opportunity is one, clients expect their advisors to at least be looking at their personal risk and having conversations around them. And so, having a 15-minute conversation with your clients about their overall personal insurance needs can greatly shift the landscape of their protection going forward. And really, what that allows them to do is work with an insurance professional to build a program for them specifically and not something that's built for the I say average household because there's not an average household out there anymore. So these box products that we see on TV usually don't fit your clients properly. They can be endorsed to fit them properly, and that's what we're going to really focus on today is again that language and where you guys can support your clients in understanding the complexity. So we are going to cover a lot of topics. I tried to group them into about 7 different ones. We will spend a decent amount of time on homeowners. That's your client's largest asset in a lot of cases, and also where a lot of complexity comes in from the personal insurance side. We'll also talk about auto and excess liability, the financial rating. You all look at financial ratings on a lot of different aspects, but tend to overlook that when it comes to personal insurance, but that can have a huge impact on your client's claims experience. And then what does it actually mean bringing it into the plan? So, the first thing we're going to discuss is the valuation. And there's a few different numbers that clients tend to think of when you ask them about what's their dwelling insured for. A handful of clients aren't going to know this, but it's probably insured for market value, which is what they bought the home for. They went to their lender referred them to a mortgage, or their mortgage person referred them to an insurance broker. They asked what they were buying the home for, and that's what they wrote the policy for because that's what satisfies the mortgage. In all reality, though, the home needs to be insured at rebuild costs. And this is looking at the materials, the labor, and different things that it takes to actually rebuild a home, not what it takes to sell a home. And one thing that I would also hear a lot when it comes to the rebuild cost is, well, my builder said they could build it for less. And a lot of cases, what that means or kind of attributes to is the builder does it at mass. So, of course, if you're building 10 homes in one neighborhood, it's a lot cheaper to build those 10 homes at one time versus coming back 10 years later and just building a single home. So, when we talk about rebuild costs, it is something that insurance companies calculate. They have their own calculators. We use a group called CoreLogic that a lot of insurance companies use, but this is a number that is figure outable, if that's a word, but really something that your client should understand and make sure they're in line with. And so from the rebuild cost, there's 3 different ways that you can insure a property. One is the replacement cost. So this is the ideal way to insure a home. It means there's no depreciation at time of loss. Your client's made whole again in a lot of situations. And in most cases, what a mortgage company would want to see when it comes to the actual rebuilding. We then
And
see functional. Oh, yes,
we
Sarah.
received a really quickly, we received a question. How do we determine the rebuild cost?
Yes. So I will take you, the next slide actually talks us through how we
Okay,
calculate the rebuild cost. And we do have a tool in app that I can highlight at the end as well.
awesome.
Um, when it comes to functional replacement costs, there is a need for this in the industry. Where functional replacement cost becomes like a downside is when clients don't know that they've bought a policy that is on a functional replacement cost, and they maybe bought a historic home because they love the crown molding, they love the craftsmanship of the real wood and the stone tiles that are imported. They're not going to get all of that back unless they have replacement costs. So sometimes the agent and the insurer don't talk and they don't know why they bought the house. They just know they want an affordable premium. So sometimes they will put on a functional replacement cost, which just means that the insurance company can rebuild with similar quality and doesn't have to go into the unique details. That were maybe originally put there. And then lastly is actual cash value. We don't see this a lot on like the entire home itself, but we do see it on parts of the home, whether that's the personal property, on the roof, but there are situations, especially when clients have rental properties, where we do see actual cash value come into play for rebuilding the home. And that can leave your clients out of pocket a lot of money If they're prepared for it, again, not a bad idea. When it comes to insurance, we're transferring risk that clients don't or can't comfortably insure. And sometimes actual cash is all they want to transfer. So that's the other reason knowing these different terms is important because rebuild cost isn't always what's right for your client. Maybe they did buy an older home, but they're okay with the plaster walls being replaced with drywall. Well, then they need functional replacement costs. They don't need to overpay for replacement costs, but they bought the home because they love the plaster, then we may want to invest in a replacement cost policy so they can have that work done at time of a loss. So, how do we come up with this lovely number? There's a few different ways, but really it's as simple as the address that the client has. There's a bunch of different data, though, that then comes into it. So, we look at the style, how many stories is it, the square footage. We'll look at debris removal as part of the coverage. We also look at things like wall height. That's again something that a lot of the systems that are generated, whether it's State Farm or Safeco or even CoreLogic, they'll have a lot of assumptions made. So they'll assume that based on the home being built in 2000, that the average wall height is 8 feet. But if your clients have 12-foot ceilings, that's a big difference when it comes to the reconstruction cost of it. And so this is where clients should spend time with their insurance agents going through the carrier's replacement costs and making sure that all of these details align. The other part of this is what does the foundation look like? Is it a finished basement? Is it slab? Is it on pier? And then the real nitty-gritty of the materials of how much of it's carpet, how much of it's hardwood. Is it just hardwood or is it bamboo hardwood? Like there's so much that once you start to pull back the layers of what is in this home and what does it cost to rebuild. I had more clients than I remember that had grass wallpaper, and that's not cheap. And if the whole, downstairs or dining room is full of grass wallpaper, they want that back at time of loss, but that's usually not what is populated in a standard database. So um, like I mentioned, within Holistiplan, we do provide a rebuild cost estimator where you guys can adjust some of this information, but then we do give you this actual printout that you're seeing here to share with your client and their insurance agent so they can go through this document with the fine-tooth comb. And again, make sure that all of this matters. You'd be surprised too, like doors. For me, I honestly don't know if my doors are hollow or wood. But if your clients did spend a lot of money and put in those solid wood oak doors, they're going to know that, and that's what they're going to want at time of replacement. So this is how insurance companies come up with the replacement cost. And again, every company uses a slightly different calculator. Some of them do use industry ones like CoreLogic, and there's a few other names out there. But then there's groups that use their own built in to their application. And then there's a third part to replacement costs, which is a lot of times we'll see discrepancy between a standard insurance company and a high net worth insurance company. And I used to get this question all the time of, Megan, why does Chubb or Cincinnati want to insure my home for $2 million, but I'm with Liberty for 950,000? And the reality is it's how they rebuild the home. So a standard market usually is going to replace the home with that similar kind of quality. So again, if your clients have a full brick home today, Liberty Mutual is going to replace it with a brick veneer. Again, may not matter to a lot of clients, but other clients that might not be okay and something that they want to invest in. Where if you're with a high net worth carrier, they tend to replace with same kind quality. So again, you're going to get that craftsmanship. If the client has 4 layers of brick, you're going to get that 4 layers of brick. When I was an insurance agent, I had a client that had a Ludovici tile roof, which is tile that was made back in the early 1900s. I live in St. Louis. We get a lot of hail. There was a hailstorm that came through, and Cincinnati replaced that entire roof for over $350,000 because, according to the Homeowners Association, they had to put a Ludovici tile roof back on. They couldn't go with the shingle roof or a knockoff roof. So that's the other thing. Sometimes understanding, especially in like historical districts, what clients are required to replace with, and if similar is even okay, can really make a huge difference. So that is also why you will notice with our replacement cost calculator, there might be a difference between those high net worth companies and what you're seeing because CoreLogic is more for that middle market type home. You can make those adjustments, show the bathroom as luxury, the kitchen, as designer to help get it to that higher quality, but it really then comes down to the policy language and how things are handled at time of loss. But that's why you will notice for your clients that have custom homes or older homes that the replacement cost can be drastically different between a standard and a high net worth carrier. And that's just, again, based on those policy languages. So, what does this all actually look like at time of claim? When we have a true replacement cost policy, this is the smoothest option for your client. They're going to get full replacement costs. They know their max out of pockets, the two or $2,500 deductible. So regardless if it's a partial claim of, 45,000 or a total claim, their out of pocket does not change, which is obviously ideal. And with some companies, there's actually a large loss waiver. So if the claim's over 50,000 or 100,000 in some states, your clients pay nothing out of pocket. So we'll talk about that later. But then what if your client had that functional replacement cost? For some clients, this isn't an issue. They're okay with going to drywall from plaster, so it's not really going to be 15,000 out of pocket. However, if you have those clients that bought the home based on its characteristics and they liked the plaster, they are going to be the ones out of pocket $15,000. And so that's where this functional replacement cost has a place in time, but the clients have to be aware of what they're trading off for that premium savings. And again, at time of a larger claim, there's a little bit more of an impact if they want to rebuild to the same material. And then lastly, actual cash value. This is the most expensive way for a client to kind of have a claim handled. As you can see, there's depreciation taken into account. So how things are aging matters. Overall, $20,000 up to $195,000 versus a $2,500 difference. So as you can see, depending on how homes are covered can drastically impact what your client is paying out of pocket. And then there's this lovely extended replacement cost and co-insurance battle that happens. So a lot of people will come to me and say, Megan, my client's insured for $500,000 and they have a 25% extended replacement cost rider, which gets them to the true replacement cost. So aren't they good? Why do we need to bump the rebuild cost up if they have extended replacement cost? Well, the answer is because extended replacement cost is not meant to fill in that 80% gap of underinsurance. Extended replacement cost is meant for when a catastrophe happens, whether it's a tornado, a hurricane, a fire, and multiple homes in the area are damaged. So the cost of labor and lumber increases due to supply and demand. Your clients have that wiggle room to pay for those additional costs. Where we see this become a really big issue is when clients think they have extended replacement costs, but their policy also has a co-insurance clause. And what a co-insurance clause states is that your clients have to be insured sometimes as low as 80%. A lot of times they have to be at 100% to rebuild value in order for the extended replacement cost to even kick in. So depending on if your client has a co-insurance policy, they may never even see this rider if they're not insured 100% to value. So what does that again look like at time of claim? This client had a tornado happen. Their rebuild cost was $750,000, but due to supply and demand, it actually ended up costing them $845,000 to rebuild the home. Based on the home only being insured at $600,000, that was 80% of value, which did not live up to the co-insurance clause for this client. So what does that actually mean here? The math breaks down to what did the client carry over what were they required to carry? So they carried 600,000, they were required to carry 750,000. And what is that adjustment? So instead of getting the 845,000, really what they would have gotten had they had the right coverage is up to 749,000. However, they had only purchased $600,000 and insurance is never going to leave you in a better situation if you don't meet all the requirements ahead of time. So what ends up happening is that clients out of pocket $247,000 because they didn't meet a simple co-insurance clause because they thought they were being, smart by saving a little bit of money by dropping it and just adding on that extended replacement cost endorsement. How this should actually work is the client has a claim, they're insured for 750,000. Again, that tornado came through, so now it's 845,000. They paid their deductible. There's no penalty because they were insured to value. And again, our client's only out of pocket $25,000 versus the 250,000. So this is where, again, that confusion of stacking different coverages doesn't always work as intended. And there's that fine print in insurance that really makes certain things align and or not align. And a perfect example of that correlation is extended replacement cost and co-insurance clauses within a policy. So when it comes to insuring homes, there's a few different forms, but the most common ones are our HO3 and our HO5. HO3 is the absolute most common one out there. It insures your dwelling for open perils, which means everything's covered unless specifically excluded. And then your personal property is named perils, meaning it has to be a fire, water, or something that is listed in the policy in order for coverage to apply. On an HO5 policy, which is really what you all want most of your clients to carry, this is an open peril policy for both contents and the home. And in my opinion, it really puts the onus back on the insurance company to prove that the loss is an exclusion. Whereas when it's a named peril policy, it's really on the client to show that it's a covered loss and that it falls within one of the named perils. So HO5, again, just makes claims a lot easier. It broadens the personal property language. You would be shocked at how many claims can actually happen to personal property that are excluded, from really nice oriental rugs having wine spilt on them to your kids having a party at the house and there being, invited guests onto the property and then damage being done. The list just kind of goes on, but not all carriers actually offer an HO5 policy. And so, in those situations, there is a special personal property that can be added to endorse it to broaden the personal property limit of an HO3. And what does that really look like for your clients? So this client had an HO3. There was a deer that came through the back door of the home. Unfortunately, it damaged and left blood on a lot of different property. Some TVs were taken down. And based on the HO3 policy, the client only had $2,500 covered because the only thing that had open perils coverage was the dwelling, and they were out of pocket for the entire personal property damage. If they had the HO5 policy, they again would have been out of pocket only $2,500 because deers breaking into the home is not an exclusion, which means there is coverage under this policy form. And like I mentioned, if we added the special personal property to the HO3, it then would have also changed this claim to reflect 2,500 out of pocket because now we're opening up that personal property coverage. So again, a lot of times you will see an HO3 policy form, but then a special personal property endorsement that is a different version of an HO5 policy. And then we have personal property. So, water damage is something we'll also talk about during this, but what and how is personal property kind of figured out at time of loss? There's two critical paths, which is actual cash value or replacement cost, similar to what we talked about on the homeowners, in that there's depreciation taken into the actual cash value, but it makes a huge impact at time of claim. So a client who had a $35,000 loss with actual cash value on the personal property is only going to get about half of what that is if the personal property is at, for this example, the TV was 6 years old, and some other items. So they are out of pocket almost $17,000, where if we would have had replacement costs on the personal property, we're only paying our deductible and getting that full 34,000. So again, these little things matter. You would be shocked. We see it multiple times a day in our system that clients don't have replacement costs on their personal property. They have actual cash value. Again, when they were shopping their rates, they were looking for a cheap price. Some agent heard cheap rate. They're like, okay, we'll remove personal property replacement costs. That'll help us save, $150 a year. And now we look better. And so this again is something clients aren't always aware of. They don't always fully understand, but makes a huge impact when they do have a claim against personal property. And then there's landlords. I don't have a lot in this presentation on landlords outside of it's really important for your clients to understand that if they rent their home out, and they're not living in it as a primary or secondary, it does not belong on a homeowner's form. It needs to go to a landlord policy. It has different coverages, different exclusions that your homeowners may or may not have, and really is intended for those short-term, long-term, mid-term type rentals. It does not cover the tenant's belongings, but it does cover the landlord's exposure from the property. Maybe they do have some personal property like refrigerators or appliances on premise, and then really just like the different structures. When it comes to landlord policies, they don't follow the same HO3, HO5 rules. They follow what's called a DP1, DP2, or DP3, which is just a dwelling policy. And really, the DP3 is kind of that open form, and then basic is very, very basic, not to be redundant there, but sometimes this only covers fire loss, where there's no liability even part of this. There's no medical, there's no personal property. So it is important to understand what policy form your clients are on. To one, make sure that they know what's exposed, but two, to see if it even qualifies for liability, which is a big gap that could find itself onto the umbrella and or not on the umbrella if it's not addressed sooner than later. So another big issue that I saw when I was an insurance agent and that a lot of people didn't understand was what is loss of use and why is this important to my client, especially again when those natural catastrophes occur and now there's only a handful of rentals in the area in the same school district, but there's multiple families kind of fighting for those rentals. One thing that people forget is if your home becomes uninhabitable due to a covered loss, you still have to pay your mortgage. And so if you don't have the right loss of use coverage, you might be stuck paying a mortgage and rental, which can just be a lot and during an already difficult time. So when you kind of just think overall about the math problem, what does it cost to rent somewhere? How long are they going to be renting for? What does that exposure look like? And then there's also additional coverages or costs that can be covered in this, such as food and like incidental things while you're not living at home. So we also see time frames. Again, a lot of people are like, oh my gosh, 24 months, that's more than enough. If it is a total loss and there is a lot of homes or even just a single home, I saw one client who had a total loss that took over 3 years to get rebuilt and redone. And so if they had not had unlimited replacement cost or unlimited loss of use, after year two, they would have been paying for that last year of rent themselves. That would not have been very fun for them to do. So this is also where it's not a lot of money on a policy, and having that flexibility at time of claim can be really nice for your clients. And so encouraging them to just review this limit and consider maybe a unlimited option is where, again, you can, as an advisor, add value just what based on what you know about the area, the schools, and kind of where your clients operate. And again, just really asking them if something happened, what would the rent be for a comparable house in the area? And do we feel, the limit is sufficient at this time? And then we have personal property when it comes to scheduled items. So a lot of, well, all insurance policies have limits within their personal property for things like jewelry, art, collectibles. Some have higher limits than others. So your high net worth companies tend to have like 5 or 10,000 in these categories, where your standard companies definitely have more of what you're seeing on screen here. This again is something that a lot of clients are shocked when they have their first jewelry loss. Maybe it's an engagement ring or a nice pair of earrings while they're traveling. Not only are these sublimits, but these go on the or these have the deductible applied. So if your client has a $2,500 or $5,000 deductible, this coverage becomes again not as useful because they're probably just going to cover the claim out of pocket and not look to insurance for an additional 1,500 if they're already paying five or $10,000. But what they should consider is a valuable policy. So this can either be a rider or a standalone policy that clients can schedule or blanket their valuables on. So this is where a lot of clients, though, can find themselves over insuring their property. So when we think about what should clients schedule, it's what can they, one, not afford to lose or afford to replace, but two, what do they want to replace? If it's their grandmother's pendant that they just love because it has sentimental value, but they're not going to go out and get another pendant that they can wear to, different dinners, then they probably shouldn't insure that. Because while it will be a very sad loss, there's no reason to invest money to insure it if they're not going to use the insurance if and when it's lost or damaged. So sometimes when it comes to the scheduled personal property, there is this, do we need insurance to replace it? Are we going to replace it? And kind of what's the balance between the two? There's also no deductible that applies when it's listed as a scheduled item. Usually, some companies can put on small deductibles if they like. Um, and then the other big piece here is if this is part of your overall balance sheet, and again, if clients had a total loss fire and all of the art was gone, would that affect the balance sheet if the insurance company couldn't replace it? And now they don't have 500,000 in art anymore, or they need to pull out money so they can go buy art because their new home feels bare without it. There's a lot of different things and impacts that end up flowing into your world if it's not addressed ahead of time through insurance. And then another topic that comes up a lot is water damage. And I was actually talking with an adjuster friend a few days ago. And the sad part is when a client calls in about a water claim, how that water damage happened is critical. And how they explain the water damage happening within that first interaction can really set the tone for what the client's going to experience. So the most common one we see is those sudden and accidental water losses. So this can be a pipe bursting and something that the client doesn't know is happening in the background or isn't occurring over time. And again, just randomly happens. We then have water backup. So this happens when water comes into the home through drains. This can happen due to like the lateral lines being collapsed, tree roots growing through it. In St. Louis, we get a lot of rain, and sometimes if we get too much rain, the sewer systems can't handle it, and we actually get sewage pushed back up into our homes. And so without an endorsement for water backup, your clients could be out of pocket quite a bit of money, not only to sanitize and get the water and whatnot out of their home, but also replace any of the finishes. So those finished basements, if they're like my grandmother and they stored everything in the basement, that can add up really quickly if this is not addressed ahead of time. We then have seepage and like gradual leakage. This until recently was just a standard exclusion. You really couldn't buy coverage back in the marketplace. But over the last 5 years, we have started to see insurance company offer endorsements for seepage and leakage. And so this is something where like maybe you have a pipe behind the wall and it's a gradual leak that happens over time. You can have a sublimit for the damage that occurs over that period of time, where in the past it was excluded because it wasn't sudden and accidental, which is what we saw in column one. So again, this is something depending on where your clients live, is an important water coverage to consider. And then we have flood, or also known as surface water. So again, how water comes into the home matters. There were a lot of times where clients didn't describe water coming into the home properly, and the adjuster initially assumed it was flood damage when it actually was water backup and they had coverage for it. But when we talk about flood damage, this is water that enters the home through the ground. So finished basements are really important to consider, especially when they have those ground level windows where, again, we get too much rain. It can kind of start to come in through the windows. We had a lot of claims or come in through the walk-in back door of the basement where maybe leaves covered the drain, that homeowners weren't there. It rained really hard, and before they knew it, there was water in the basement. And or just a typical flood where there's a lot of water and it's coming in your front door, windows, and everywhere. This is a newer endorsement, one that can be added to some carriers' homeowners, but you can also buy standalone policies. So there's the National Flood Insurance Program, which also is known as NFIP. You can buy it from a bunch of different agents, but you're going to get a flat rate. So it doesn't matter who you buy an NFIP policy from, you're going to get the same rate. There are also private insurance companies, though, that are or can be more competitive, especially for clients that aren't in a quote unquote flood zone. That one also gives coverage for things like finished basements. They don't give a lot of coverage, but they do give some coverage. Your NFIP policy is not going to give coverage for a finished basement. The last thing I will say about floods is 40% of floods occur outside of flood zones. So just because your client is not in a flood zone, just because the mortgage company does not require your clients to have flood coverage, does not mean your client should not be exploring flood. And I also know this is becoming a larger issue because about 10 years ago, when I first got into insurance, not everyone talked about earthquake. And then we slowly started seeing at renewals, insurance companies were putting on like this, it would estimate cost for earthquake would be XYZ a year to like show to the consumers that they're offering it. And now it's up to them to decline it. And we're seeing the same thing with flood. They're now stapling these flood flyers onto the renewals. So if the clients do have an uncovered loss, the insurance companies can say, no, no, we offered it to you at renewal. You just didn't choose to buy it, which in my opinion indicates that there is a need, that there are claims happening. And if the insurance industry is looking for a CYA, your client should probably look into it a little deeper and just make sure that there isn't a exposure for their specific location, and or if it's worth transferring if there are concerns. And so what does this really mean from a dollar standpoint? Again, busted pipes, these can range from anywhere, average around 5 to 40,000. This is the most typical water loss we see. Those water backups, again, if your client has coverage, they can pay as little as their deductible, but without coverage, they're going to be out of pocket quite a bit, especially if there's biohazards part of that cleanup. We also have that seepage and leakage that can be endorsed for a small price, and without it, your clients are going to cover 100% of those losses. And then flood, as you can see, our average NFIP payout was about $66,000. And this is a way for clients to transfer some of that risk, as again, 40% of these are occurring outside of flood zones at this point. So when we talk about homeowners, there's also some common exclusions. So obviously flood, we talked about earthquake, we talked about, but then there's exclusions your clients don't see coming or exclusions that when they first bought the policy, we're like, that's fine, they're not in our lives. But now a couple of years later, or maybe overnight, those exclusions become issues. One of those can be dog liability. So again, maybe when they bought the policy 5 years ago, they didn't have a dog, so that exclusion was fine. They've just renewed year over year with their current carrier. But 2 Christmases ago, they decided to buy a dog for their kids, and now that exclusion has a large impact. And so without that, there could be some issue if and when those dogs bite someone and coverage being in place. Another exclusion is pool liability. We see this all the time in our system. And again, something where maybe your clients build a pool because they've been investing, everything's been going well, they have some money to do renovations to their home. Maybe they put in that above ground pool, again, something that can happen overnight pretty quickly. And without this exclusion being removed, your clients are going to have no coverage for anyone that is in that pool or damage that occurs around that pool. And then lastly is trampoline. This is one we see a lot of times around that lifestyle where, again, when they first bought the policy, they didn't have a trampoline, or sometimes they bought the policy, had one of these exclusions, and the insurance agent just didn't ask. And they didn't ask because they either knew it was an underwriting issue that they wouldn't be able to close the business or that it could deter a buyer because of the exclusion. So sometimes these don't occur overnight. These are just topics that clients don't know to bring to insurance agents' attention, and insurance agents, unfortunately, sometimes are order takers and don't always know to ask these questions or dive deeper into them. So another exclusion we actually have started to see in the marketplace too is a water exclusion. So that sudden and accidental pipe burst that I mentioned a few minutes ago, that is also now being excluded and or limited to like $10,000 or $20,000 like other water damages. So that's not in the standard market really today. So you're not going to see that with like a Safeco or anyone, but we are seeing it in the non-standard market. And I would say at least 2 to 3 times a week, we have a water exclusion come through Holistiplan's review process. And so, what does this mean if our client has one of these exclusions? Dog bites are very, very common. So, an example would be if the Johnson family had a golden retriever, neighbor kid was over, unfortunately got bitten. With the exclusion removed, the client would have it all covered. They would also have their any legal fees covered. I think that's a part of liability people often overlook is the legal fees are part of it, and your defense costs are part of your liability, so you don't have to pay for that. Without it, or if there was a breed exclusion, they would be out of pocket around $65,000. And 1 in 3 homeowners liability claims do come from animal bites. For pools, again, very common, more serious. Client had a 4-year-old, unfortunately, drowned in their backyard. Without the coverage, they would have been 100% out of pocket. With it, the insurance company is going to cover the damages plus legal costs. Around 60% of drownings occur in residential pools, though. And there was one in 2023 in Texas, unfortunately, that paid out $18 million. So again, this is where creditor accessible assets really become an important part of the conversation. And then lastly, just trampolines, it can be as simple as 2 kids having a good time. Unfortunately, one just bounces the wrong way. And before you know it, there's some spinal injuries and those medical bills add up quickly. So again, these are just common exclusions that can quickly interject themselves into clients' lives and really have a large detriment to their overall lifestyle. And I know we're getting somewhat close to time, so I'm going to speed up a little bit. When it comes to roofs, there's a few different ways that clients can have their roofs figured out. So one is an actual cash value settlement. This means depreciation is taken into account. It's very common in today's insurance policy, and it's one way to help lower premiums and for insurance carriers to alleviate some of the risk when it comes to roofs. We also see a payment schedule. This is a little more predictable for your clients. They'll know upfront what the value of their roof is versus actual cash value will depend on the actual time of claim. And then replacement cost. This is ideal. This is actually hard to find in the marketplace today, especially if a roof is over 15 years old. You can expect your clients to have ACV or a payment schedule, in most states. The other thing I wanted to call out here is a lot of companies are removing the matching of siding and roofing, meaning they're only going to replace the damage and they're not going to match for cosmetic issues. So if your clients do want their entire roof to match, this is something that they should make sure is part of the overall policy. And then what does this really look like at time of claim? Again, when it's actual cash value, your clients are going to pay more than the insurance company does. Uh, Payment schedule a little more even. Again, it will eventually tilt to the client paying more as the roof gets older. And then replacement cost is straightforward. The client knows their out of pocket is 2,500 and the insurance company is going to carry or cover the rest. And then we have deductible structure. So there's three different ways we see deductibles listed on homeowners policies. One is the all peril deductible. This is really what applies to most losses. Clients tend to carry 1,000 to 2,500. I personally recommend higher, especially if they don't file claims frequently. We then have our CAT claims. So these are going to be separate deductibles for things like wind, hail, fire. They become very common in today's marketplace, especially in CAT-prone states. And then we have our endorsement. So again, this is something else we've started to see in the marketplace where now the water backup has a certain deductible. The cyber endorsement has a different deductible. The service line has a different deductible. So sometimes your clients can have more than one deductible, and depending on, again, how or where that claim occurs would affect which deductible is applied. And so an example of this is client has an all peril deductible of 2,500. Depending on the loss, if it's over 50,000, this client had a large loss waiver, so they actually don't pay a deductible, but pretty straightforward. With a wind hail deductible, this is not a flat deductible, so it's usually a percentage. And so it's a percentage of the dwelling limit. Every year, the dwelling limit increases due to inflation, typically with a good insurance company. So their out of pocket's also going to increase year over year just based on the math here. So again, this is a little harder for a client to understand, and or they sometimes are shocked when they go to file that roof claim and it's actually wind damage for the roof and they're only getting, 10 out of the 22,000. And then lastly is that deductible endorsement. Pretty straightforward, but if a client had a water backup claim, it was 8,500 in damage, they're only going to pay that endorsement deductible of 1,000. The biggest thing here is though is that this large loss waiver does not apply to wind and hail or endorsement deductibles. It only applies to the all peril deductible. So again, sometimes that's something clients aren't aware of. They think it applies to the wind and hail, so they have this false sense of security that a 2% isn't that bad because they can waive it, and that just doesn't work that way, unfortunately. So something to keep in mind when it comes to deductibles. Alrighty, so when it comes to auto and excess liability, there's two ways to look at auto. One is split limits, which has a per person cap, a per accident cap, and then a property damage cap. This is the most common way we see it, but this does and can potentially leave your clients out of pocket. An example is, let's say they unfortunately hit a brand new Ferrari that should know what this costs, but we'll just say 175,000. That's probably on the low end. This client's only going to get 100,000 in coverage, and that additional 75,000 is coming out of pocket. Whereas with the combined single limit, we remove the per person and property damage cap and just give you the bucket of money of 300,000 to use however clients need at time of a claim. So just more flexibility, and my preference, if available, is the combined single limit. One thing though I did want to point out is, again, 10 years ago, permissive drivers were just automatically covered. If you handed your friends your keys, they could drive your car and these limits would apply. That is not the case in all states today and with all carriers. So there now are what we call drop down limits. So if you hand your friend the keys to the car and your carrier is one of them that has drop down limits, you actually get state minimum coverage while friends are driving the car. You don't get the policy limits you see here. So again, this is just something to be aware of for your clients and make sure they do let people use their cars, that it's just not the generic, oh yeah, they're good to go. It would be check with your agent and make sure there's no permissive user issues. So what does this kind of look like at time of claim? $300,000 accident Michael caused. It was for lost wages, legal fees, and injuries. With split limits, the entire claim is not covered. Only the 100,000 is for that per person. The additional 200,000 would be coming from Michael in some way, whether that's wage garnishments, asset allocation, whatever it may be. Whereas with the combined limit policy, he would not have paid anything out of pocket because he had the full 300,000 to use how they needed. Another misconception is like medical payments versus personal injury protection. In most states, you can buy one or the other. There are certain states where you can buy both. And the biggest difference here is the wage replacement. So medical payments really is just for that. This is actually a coverage your clients can use at time of an auto accident to pay for their medical deductibles, their copays. Same with personal injury, with, again, the biggest difference is personal injury can pay out some wage replacement in the states that it's available. And then another thing that a lot of clients are shocked and advisors tend to also be surprised about is when a client has a total loss to their vehicle, that it is figured out on an actual cash value basis, not at a replacement cost basis. So, unlike the homeowners, your clients aren't going to always get that replacement cost. A lot of times there's depreciation and other things taken into account. You can endorse a policy to have agreed value, meaning clients can't agree with the insurance company upfront on the value. And if there is a claim, it is super straightforward, very nice, and the client just gets a check for that agreed value within a timely manner. So what this really looks like at time of claim is a client bought a new car. It was $58,000 when they purchased it. Based on depreciation, the total loss are going to get about $4,700. With an agreed value at time of renewal, it did drop a little bit, but it's still closer to 54,000. Plus, they get their upgrades included, and they now have around 50. Oh, that math's wrong. 57,000 in coverage. Or no, 56 because they paid their deductible. So about $9,000 more. And a lot of times clients do want to invest in their greed value. It just makes it easier. Buying a car is already a pain and overwhelming. And so, again, just something that it's very typical to have ACV on cars, but there is the option to upgrade. And then this is a big one that a lot of people are shocked to find out, but umbrella liability and excess liability are not the same thing. While people tend to use these words interchangeably, excess liability policies are just that. They follow, or they're also called follow form, but they follow over the underlying limit. So if your clients have, again, their personal liability, they have coverage on the umbrella for whatever's underlying. Let's say the client doesn't have personal injury coverage on their homeowners, that means they're not going to have it on their excess liability. However, if they have a true umbrella policy that can pay drop down limit or first dollar limit at time of claim, as long as personal injury is an exclusion on the umbrella, they can pick up first dollar at time of claim. So what that looks like is this client had a defamation case brought against them. The claim was for about $300,000. There was no underlying coverage, but since the client had a true umbrella policy and no other exclusions were within any of the underlying coverages, the umbrella was able to pay the first dollar and pay the full 300,000. Without the underlying and with just the true excess liability, there was no coverage because the underlying homeowner's policy did not include personal injury coverage. So that's the difference, and sometimes why you see $1 million liability policy can cost more with one carrier than another because the one that usually costs more is a true umbrella policy, where the one that is probably a little less expensive is just that of excess liability when necessary. And so the other big thing that clients often overlook is gaps between what they're required to carry on their umbrella and what they actually carry. So this a lot of times happens when the umbrella is with a different carrier than the auto, but it can quickly add a lot of out-of-pocket expenses for your client. So for this example, the client was required to carry 300,000. However, they only had 100,000. So before the umbrella kicks in, your client's going to have to come up with the $200,000 difference. Whereas if they had the underlying limits in place, the umbrella would automatically kick in and the client would be able to move on seamlessly and have their program interact like they had imagined. And then really umbrellas aren't all created equally, and there can be a decent amount of endorsements added. So one is on excess uninsured and underinsured motorists. This is in addition to what clients would have on their auto, but this is really important for clients that like to bike and be outside or again travel. Uninsured motorist covers you while you're a bicyclist and a pedestrian with most carriers. So again, depending on the family makeup, if there's a lot of them in a car that travel together or again outside, this can become very important. Employment practices liability. This is going to be for your clients that have nannies in household or full-time healthcare people working for them. They can get sued for sexual harassment, discrimination, and these are coverages that they can purchase through an umbrella. So if they find themselves in that situation, not only do they have monetary, compensation to help support that, they have a team of defense attorneys to help them defend in those frivolous lawsuit situations. We also have nonprofit exposure. So even if a board has their own nonprofit coverage, that can be exhausted pretty quickly. And in certain situations, once the board's liability is exhausted, clients' personal assets can actually be out there in certain states. And so in those situations, clients can add $1 million in coverage for about $500 a year to an umbrella policy. So they would have that coverage extend to them if and when it was needed. And then lastly is uninsured liability. So slightly different than excess underinsured for motorists. This is going to cover clients who get injured on someone else's property that don't have enough insurance. So maybe they like to go to their friend's house and go swimming, but their friend doesn't have an umbrella and they get severely injured. Or maybe they have kids away at college and they're just, again, having a good time, but they're on some questionable properties at times. This is a great way to have that peace of mind internally that if there's other individuals in this world that don't have the right liability, you can rely on your umbrella to pick up and kick in when necessary. And so, how do we calculate the right umbrella limit? First, we are going to start with net worth, but then we want to subtract any assets that are protected. So, a lot of times in states like Texas and Florida, the homes are protected. We also want to review how things are titled. Is there, depending on the LLC or the trust that's selected? And then, based on that, is what we're going to look at for an umbrella limit, which is those exposed creditor accessible assets. So, for this example, the client is a married couple, 3.2 million. They live in Texas. Texas does have a homestead protection. They don't have any coverage on their brokerage accounts. Their retirement accounts are protected. Their vacation home has some exposure. So all in all, they have about 100 or 1.4 million in exposed assets. We do recommend rounding up in umbrella coverage. So buying a $2 million umbrella is what I would recommend for this family who has a $3.2 million net worth. Liability is the cheapest thing your clients can purchase. So that's also why you'll notice going from like a $2 to $5 million umbrella might only be 500, max $1,000 a year. And then financial rating, and I know I'm coming up on time, so I'm going to scoot through this, but financial rating is really important because this is what impacts if they can actually write the checks when your clients have a claim. So for insurance, we use AM Best is the one I recommend going to, but then there are certain companies in like Florida that are Demotech rated, which is just slightly different, but still a good way to get a understanding of kind of where they are from a capacity standpoint. I did include some different ways to look this up, so I'll let you all look through this on your own time. But what this really means is A-rated carriers means your clients are probably going to get the claim paid. Their out-of-pocket is going to be their deductible, and they're going to be able to move on with life. When we have a B-rated carrier, it could mean that there's going to be a drawn out process. Your clients may not get the full out of pocket or the full coverages, and there could, again, just be some delays in what that all looks like. And then if a company becomes insolvent, the policy itself was real, but the company wasn't. So in some states, they do have state guaranteed funds that would kick in. In other states, your clients could just be out of pocket all of that money. So this is where understanding the financial stability of a company can also help you understand if we're investing dollars in the right transit or transfer of risk. So let's bring this all into the plan in the last 8 minutes. So when clients have an uninsured loss, it does not go away. It comes to you all. It moves to the portfolio because most clients aren't just going to be like, oh, I guess I'm not rebuilding my home. They're going to say, how do I get to this $175,000 of underinsurance? And the answer is there's four different ways probably. One, 401k distribution. Maybe a loan can cover a very small piece of this. You could potentially get a home equity line of credit, but if you have clients in retirement, that might be kind of a gut punch if they just got done paying off a mortgage. And or unfortunately, the most promising one is a taxable account sale. And high level, what some basic math around this is there's some federal income tax, there's early withdrawal penalties, overall depletion. We also, again, with the loan, have a cap of 50,000. For the home equity line of credit, there's some interest that's paid over the years that outweighs some of the cost. And then when it comes to the taxable account sale, obviously there's some capital gains and different things that become part of it. So overall, as your advisor, your job is to recognize potential exposures. Then ask the questions to your clients about their last time they reviewed this actual cash value things, and then bridge the gap. Remember, you all have so much context that would make such a difference to an insurance agent in your client's conversation that that is what you're we're looking to do here with you is take all the amazing information you have and bridge the gap so your clients can get the right coverages. Your job is not to recommend specific policies. It's not to interpret language. It's definitely not to hold yourself as a PNC professional, but it is your job as a CFP to identify potential gaps, to note whether deductibles align with emergency reservations, and really document those insurance observations. And this is what Holistiplan is here to help you do. And so real quick, just again, help evaluate needs, deductibles, and then really align with your role as the planner. So when you upload documents into Holistiplan, our Holistiplan report pulls out most of the information that we just talked about, all these different terms. So we pull out if there's water limits, we'll pull out those exclusions, animal, trampoline. We'll talk about those deductibles so you can make sure the emergency funds are appropriate. We'll also just give some general insights into like personal property inventory and allowing your clients to be better prepared for time of a claim. For the auto, once your clients upload their documents, we're automatically going to check if the bodily injury limits meet your firm preference. And if they don't, we're going to flag that for you. We're going to educate them that their car is actual cash value. We're also going to educate them on the difference between uninsured and underinsured motorists. In some states like Pennsylvania and Georgia, we also call out tort limits or additional stacked or unstacked when it comes to uninsured. And then on the umbrella, we're going to help check just the limits and making sure the underlying limits match. So again, if the underlying limits don't, we're going to call that out automatically for your clients to understand. And the even better part of all of this is every red insight automatically ends up on our agent letter. So this is how you help clients take the next step. These are questions that they can now go to the insurance professional with and get the answers that they need. They're still going to come back to you and say, hey, if I increase my deductible from 1,000 to 10,000, it saves, $1,500 a year. Should I do that? And that is your job as the advisor to probably say yes or no because you understand, can they afford that increase based on that $1,500 savings? So that is really all. I appreciate you all listening to me. I'm sorry I had to kind of buzz through the end of it, but we have about 4 minutes for questions. So, Sarah, if there are any, I can answer. I'm also happy to stay a little late if folks want to stay on.
Yeah, thanks, Megan. Insurance is a very complicated topic, is what I'm saying. And that is reflected in the number of questions that we have. We have about 20. And so let's get through as many. And then, yeah, I'll share some questions with you post webinar. And then if we can just distribute those out in our follow-up email, that would be great. But
Amazing.
going from top to bottom, Zach asks if they meet the, say, 80% co-insurance minimum, do they get to the extended replacement regardless of what happens, or does there have to be an unexpected event such as a natural disaster?
Yeah, great question. So it's really going to depend on the policy language, how that all interacts. But a lot of times, as long as the co-insurance clause is met, they should get that coverage. But my understanding is too, usually if there is an 80% co-insurance clause, they're not offering extended replacement cost as part of the policy.
Okay, so if no co-insurance clause, then the extended replacement doesn't apply in the negative way that was discussed earlier?
Correct.
Okay, cool. Next question. Once a claim is filed, is it better to turn everything over to the insurance company to handle, or should the client seek out the best contractor to work with?
So both. One, the insurance company is going to handle all the different, like legalities and the estimates, but having a contractor, one that's worked with insurance companies before, is very important because insurance companies do require a lot of documentation. They need photos, they need approvals before things change. So going with a low budget contractor that's never worked with an insurance company at time of claim is not the right move. Finding a contractor that's worked with an insurance agent and meet your expectations is an important overall decision when doing it. But I will say the difference between the contractor you can hire can depend on the insurance company you're with. So if you're with a Chubb or a Cincinnati, you can hire that craftsman individual to come in and do all the woodwork. Where if unfortunately you're with the State Farm, they're not going to let you, or you're not going to have the budget to go and hire some of those craftsmen to do the work.
Great. Okay, so with about 2 minutes left, I do want to just share some information about Holistiplan as it relates to XYPN and just our partnership. So, Holistiplan, we launched a partnership with them almost 8 months ago or so. And so we're very excited to just have them. They're wonderful partners of the network. And that means that if you are an XYPN member, then you get Holistiplan, you get access to Holistiplan at a discount. So if you're not already utilizing Holistiplan, if you're not signed up for the PNC insurance planning module through Holistiplan, then by all means, reach out to our team and we'll get you set up. We can also answer some of the questions there or point you in the right direction. And then if you aren't an XYPN member but are interested, then you can schedule a call with one of our teammates here. And then if you are an XYPN member wanting to learn more, then here is also the link to Holistiplan. But thank you all so much for just sharing your time with us and really trying to navigate this world that is insurance. As you can tell, it is very all-encompassing. There's so much more I'm sure that Megan could talk about for just an amount of time ad nauseum. And so we will share those outstanding questions with her and her team. And then, yeah, we'll cascade those to you all as well, along with this recording. And yeah, Megan, just thank you so much for sharing your expertise with us as well. It was a pleasure to have you again, just
Yes.
talking through insurance. But
Yep.
yeah,
Thank you
hope
for
that,
having me. It was a
yeah,
blast, and hopefully I didn't scare anyone. Our system makes it super easy. We lay that all out for you guys, so I was just nerding out with the other nerds in the room, but know that Holistic Plan does the heavy lifting when it comes to PNC.
sweet. Yeah, I'm sure that all of these folks would love to just continue to nerd out with you. But thank you all.
Thank
Thank
you.
you, Megan. Have a good rest of your day and be in touch with you all soon. Bye. Take care.